After the Federal Reserve Bank raised interest rates by just 0.25% yesterday, we saw markets rally today. Like we saw the Meta stock, the parent company of Facebook, grow by about 20%. We saw the Coinbase stock grow by about 20% today. And we've seen the almost bankrupt Carvana stock grow by about 282% year to date in 2023, and we're only in the first part of February. So what I want to do today is first talk about these three stocks, Meta, I want to talk about Coinbase, and then I'm going to talk about Carvana, what's going on with these three companies, because it's three different concerns and issues going on here. Then I want to talk about the Federal Reserve Bank and what they're doing and how their latest interest rate hike is influencing the markets. And then I want to end by talking about what's going on with mortgage rates, because we're seeing some interesting and weird things happen there. If I start by talking about what's going on with Meta, Meta grew by almost 20% today. Now, over the last few months, there's been a lot of concern over Meta because they've been seeing advertising revenues fall, and there were issues with them being too overbloated and having too many costs. Well, over the last quarter, they have been working to lean out their company, meaning do layoffs. They laid off about 13% of the company. And then they also announced yesterday that they're also going to be doing a new buyback. They just announced that they're going to do a new $40 billion stock buyback, which means the corporation is going to be buying back $40 billion worth of their stock, which then helped the stock rally. Now, you might be thinking, wait, what's going on here? How are they doing buybacks and doing layoffs at the same time? Well, this has to do with corporate governance and how our economic system works. Because you have three types of people in a company. You have the workers, what I like to call the workers, the people that are actually working in the company day to day. This would be like the coders and all of that. Then you have the thinkers. These are your C-level executives. These are the people that are directing the workers and telling them what to do, coming up with ideas on how to lead the company. So that's your CEO and your other C-level executives. And then you have a third person. These are the shareholders, the owners of a company, the people that actually invest in the Meta stock. Now, you might think that when you become the CEO, you don't have a boss anymore, but you still do. Your boss is now the shareholders, the owners of a company, because the owners of a company can direct what a CEO will do. They can put a lot of pressure on you. And you have this concept called fiduciary duty, which means who is your alliance towards? Well, your CEOs and C-level executives have a fiduciary duty not to the employees, not to the customers, but to the shareholders. So the C-level executives have a duty to increase the share price, increase the value of a company. That is the goal of the C-level executives of a company, is to increase the valuation of a company. And so now when you talk about doing layoffs, it's getting the expenses down, especially in places that are not producing a profit, and then increasing profits and making the shareholders richer, which would be in this case by doing a stock buyback, because stock buybacks increase the prices of stocks. Now, I'm not saying this because it's right or wrong. I'm telling you how it works, that we can understand the way the system works. Now, the second part to that is that Meta announced this $40 billion buyback. But the reason why I want to say this is because in a recent video released on my Minority Mindset channel, I've been talking about this whole thing of levered corporate buybacks that we've been seeing happen a lot in the last few years. Well, in the end of 2022, Meta had about $5 billion in cash on their books. So if they had $5 billion in cash, how are they going to do $40 billion with the buybacks? Well, it goes back to what I was talking about earlier, a levered corporate buyback, going into debt to buy back stock, which is essentially using debt to finance a liability. Because yes, it's good for shareholders, especially in the short term. You get to see a huge boost in the stock price, but now Facebook is going to have to pay this money back plus interest. And as long as you're making money to do that, no big deal. But if you are not making the money, well, that can become a bigger issue. This brings me now to Coinbase. And Coinbase stock popped for a completely different reason. Coinbase was facing a lawsuit that was filed in 2021. And there was a couple things that the lawsuit was alleging as a class action lawsuit. One of the things was essentially that Coinbase was not registered as a broker-dealer, saying that they weren't registered to buy cryptocurrencies and sell them. Essentially that Coinbase, they were saying that Coinbase owned the cryptos and then sold them. That part was dismissed. And then the second part was bad marketing by Coinbase, saying that they were marketing securities and not doing it the right way, marketing investments the wrong way. Well, the judge dropped the case today. And because the case was dropped, we saw the stock pop because it's like a huge relief for the company. You don't have to keep paying those fees and those fines and go through all that. You don't see a lot of wins like this, especially in the crypto space. So that was a big reason why you saw the Coinbase stock popped. And then we had Carvana, which is a third reason. Carvana has been really booming in 2023, even though it's struggling financially and has been on the verge of bankruptcy. And this reason is very different because this has to do more with a short squeeze. We saw something similar happen with GameStop and AMC when the 2020 pandemic was going on. And the way that short squeezes work, we covered this in Market Briefs. If you haven't read it yet, Market Briefs is my free daily newsletter where we break down what's happening in the stock market, the housing market, crypto, the global economy, and our own economy into a fun, witty, and easy to read email. If you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. But the way that a short squeeze works is you have a bunch of short sellers that are shorting a stock. And a short means that you are betting that the stock will go down. You make money when the stock goes down. And this has been putting a lot of downward pressure on the company. People have been shorting the stock because they think it's going to go bankrupt. And then you had some people, groups of people, you have some institutions, people on Wall Street Bets, on Reddit, people saying, oh, you have all these people shorting stock, thinking it's going to go down. If we can create enough momentum and excitement to buy the stock and push it up, well, now the short sellers will start losing money. Because when you're short, you make money when the stock goes down, you lose money when it goes up. And there's no limit to how much money you can lose as a short seller. Like if I buy a stock thinking it's going to go up and it goes down to zero, the most I lose is how much money I invest. There's no limit to how much you can lose when you short because it can go up forever. So you have people essentially shorting, hoping that we can push the stock price up, because then if you can push the stock price up, then that will push some short sellers out. And I said, hoping we will push the stock price up. I am not involved in this, so I just want to clarify that. But so people have been shorting it, and so now you have a group of people that are coming and buying to push the stock price up to hopefully force these short sellers to cover their losses, which would then make a profit for the buyers, because then that would push the stock price up even higher. So not really an issue or concern of what's happening with the company, but more of a short squeeze, a type of trade to help some people, or some people hoping will make them some money in the short term. So that's what's going on with those three companies. Now let me shift gears and talk about what's going on with the Federal Reserve Bank, because the Fed raised interest rates by 0.25% yesterday, which was its smallest hike in a number of months. And so now you have a lot of people saying that the Federal Reserve Bank is going to be less aggressive when it comes to interest rate hikes. They might stop hiking interest rates. Maybe they'll start cutting interest rates at some point in the future. Now, when Jerome Powell, who's the chairman of the Fed, spoke yesterday, what he said was, we're still losing the fight on inflation, and so you can expect more interest rate hikes in the future. Now, while he said that, he also reduced how aggressively he's fighting inflation. So we're losing the inflation fight, but now we're also raising interest rates not by 0.5% or 0.75% like we were, raising interest rates by 0.25%. So that's the first thing. And secondly, this is where a lot of people are kind of just essentially predicting the future. That's why people are jumping in, because when you raise interest rates, it makes doing business more expensive. But a lot of people are essentially now kind of betting that the fight on inflation is over and that these higher interest rates are not going to be around for a while. That's what has been causing markets to rally, because a lot of, especially tech companies, were hit especially hard by the higher interest rates, because many tech companies which don't make a profit or weren't making a profit were relying on outside capital, debt, investment dollars from investors. And when interest rates go up, investors and banks demand a higher return. As a bank, you want a higher return because now you have to charge a higher interest rate, and investors who are borrowing money need to see a bigger return from your investment because, well, the cost of borrowing money is higher. So it made investment dollars much more restrictive, which then hurt a lot of valuations of a lot of companies, especially tech companies. And so what people have been doing is buying up a lot of the really hurt companies, thinking, okay, if the Federal Reserve Bank does pivot, which companies will then see more investment into their companies, which will help these companies grow. So you've been seeing a lot of the companies that were especially beat down in 2022 seeing a big boost now in 2023, betting that the Federal Reserve Bank will change course sometime in the near future. Now, of course, we don't know what the Federal Reserve Bank is going to do. I would recommend being a long-term investor instead of a trader, but there's always opportunities in pain if you find a strong asset that is selling at a discounted price. But the way that you can really succeed is finding the good asset and investing in it for the long term. So that's what's going on with the markets, where people are kind of really hopeful and betting that the Fed is going to change course at some point in the future. I personally don't think that we're out of the water when it comes to economic pain. or inflation. But I guess time will tell. Let's see where we go in 2023. And then we have mortgage rates, where mortgage rates are still on their downward trajectory, even though the Federal Reserve Bank just changed and increased interest rates slightly. Now, this increase in interest rates will put a little bit of upward pressure on mortgage rates, but mortgage rates are affected more than just the Federal Reserve Bank, because the Fed sets the interest rates that banks have to lend money at to each other. So banks lend money to other banks overnight. That's called the federal funds rate. That's what the Federal Reserve Bank influences. This then does not direct what mortgage rates are, but it does influence it, because when banks have to pay more money or higher interest to borrow money from each other, they're going to have to charge more money to you on your mortgage. But there's more than that that influences mortgage rates. Like, there's other factors. Other factors include, for example, inflation. When inflation is high, more people are worried about the dollar. That pushes treasury yields higher, which also push mortgage yields higher. So higher inflation pushes interest rates and mortgage rates higher, and also worries of the economy can also influence mortgage rates. So just understand that mortgage rates, while they are influenced by the Federal Reserve Bank, they're not controlled by the Federal Reserve Bank, and inflation plays a big factor on which direction mortgage rates will go, in addition to what the Federal Reserve Bank does. So those are the two key factors that you want to pay attention to. Now, of course, we cover all this in market briefs, which is why if you haven't joined yet, make sure you do that. But that covers today's recap.